Two people. Same age, same salary, same city, same dream. Every January, Ryan and Ethan promised themselves they would finally take retirement seriously. They were both 30 years old. They both lived in Columbus, Ohio. They each earned $85,000 a year. Neither had any retirement savings. And after paying their bills, both realized they could comfortably set aside $800 every month. Ryan enrolled in his company's 401k. Ethan opened a Roth IRA. By the end of the first year, both of them were convinced they had made the smarter choice. Ryan couldn't stop talking about how much he was saving in taxes. Every paycheck felt just a little bigger than it should have, because he wasn't paying income tax on his retirement contributions. Ethan had a different story. He loved knowing that every dollar growing inside his Roth IRA could potentially be withdrawn, completely tax-free decades later. Each one thought the other had made a mistake. The funny thing is, they were both wrong. Not because either account is bad. They're both among the most powerful wealth-building tools ever created. They were wrong because neither of them understood the one calculation that actually decides who ends up with more money. And once you include every layer of that calculation, the result changes in a way most people never expect. The gap isn't created by the account. It's created by the decisions people make inside the account. And that's exactly what we're going to measure today. No opinions. No financial slogans. Just math. To keep this completely fair, Ryan and Ethan start with identical conditions. They're both 30 years old. They both earn $85,000 a year. They're both single. They both receive a 3% salary increase every year. Neither has debt beyond a normal mortgage and car payment. Both invest every dollar they save into a diversified U.S. stock index fund, earning an assumed long-term average annual return of 10%, close to the historical average return of the S&P 500, before inflation over many decades. Neither tries to time the market. Neither buys crypto. Neither chases hot stocks. They simply invest consistently. The only difference is where those dollars go. Ryan chooses his employer's traditional 401k. His company offers one of the most common retirement benefits in America, a dollar-for-dollar employer match on the first 4% of salary. That means Ryan contributes 10% of his salary, while his employer contributes another 4%. On an $85,000 salary, Ryan contributes $8,500 during his first year. His employer adds another $3,400. Without investing an extra penny himself, Ryan finishes the year with $11,900 invested. Immediately, that sounds incredible. Free money usually does. Now let's look at Ethan. He opens a Roth IRA instead. Unlike Ryan, Ethan contributes after paying income taxes. He doesn't receive an employer match. He deposits the annual IRA contribution limit, which we'll assume is fully funded each year as allowed under current IRS rules. Because his savings ability is higher than the IRA contribution limit, he invests the remaining retirement savings into a regular taxable brokerage account, using the same low-cost index fund. Right away, something interesting happens. Most people stop comparing here. They simply say, the 401k wins because of the employer match, or the Roth IRA wins because withdrawals are tax-free. Those statements aren't necessarily wrong. They're just incomplete, because retirement isn't decided by one benefit. It's decided by dozens of small mathematical advantages stacked together over decades. And that's where almost everyone gets fooled. Feelings and math are two very different things. Ryan feels smarter every payday because contributing to a traditional 401k lowers his taxable income today. Suppose Ryan contributes about $708 each month. If he's in roughly the 22% federal tax bracket, ignoring state taxes for simplicity, every dollar he contributes avoids paying that current federal income tax. Instead of losing about $156 in taxes on that monthly contribution, that money stays invested. His paycheck doesn't shrink by the full $708. It shrinks by considerably less. Psychologically, that's powerful. Saving for retirement suddenly feels easier. Ethan experiences the exact opposite emotion. Every contribution to his Roth IRA comes after taxes. He pays today's tax bill first, then invests what's left. Watching money leave your checking account after taxes feels painful. There's no immediate reward, no tax deduction, no bigger paycheck, just money disappearing into an investment account you'll hopefully leave untouched for decades. It's boring. It's invisible. And that's exactly why so many people underestimate it. Now let's see what actually happens during year 1. Ryan contributes $8,500. His employer contributes another $3,400. Total invested, $11,900. Assuming the market returns approximately 10% annually, his first year's balance grows to around $12,500 by year end, depending on contribution timing. On paper, that's fantastic. Nearly $12,500 after just 1 year. Sounds great, until you remember one detail. Every dollar in Ryan's traditional 401k has a future tax bill attached to it. He doesn't owe it today, but eventually, unless tax laws change dramatically, withdrawals from a traditional 401k are generally taxed as ordinary income. That tax hasn't disappeared. It's simply been postponed. Now look at Ethan. He contributes the maximum annual Roth IRA amount allowed under current IRS limits and invests every remaining retirement dollar into his taxable brokerage account. Combined, he still reaches roughly the same total annual savings goal. His Roth investments also earn around 10%. His brokerage investments earn the same market return. By the end of year 1, Ethan's total investment portfolio sits just below Ryan's. At first glance, Ryan appears to have won. His employer match created an early lead, and here's where countless YouTube videos end the conversation. But that's like judging a marathon after the first mile. The race hasn't even started. Now fast forward to year 3. Ryan's salary has increased thanks to annual raises. His contributions increase too. His employer continues matching the first 4% of salary. By the end of year 3, Ryan's retirement balance has climbed to roughly $40,000. He's thrilled. His account statements keep getting larger. His tax deduction continues every year. Everything feels like it's working exactly as planned. Meanwhile, Ethan's Roth IRA has also grown steadily. Every year he maxes it out. Every extra retirement dollar flows into the taxable brokerage account. His combined investment portfolio reaches approximately $37,000 after 3 years. Ryan still leads. On paper, that's about a $3,000 advantage. Sounds impressive, until you subtract something people almost never discuss. Investment fees. Even tiny differences matter. According to data from the Investment Company Institute, many employer-sponsored retirement plans have become significantly less expensive over time. But fees still vary widely depending on the plan. Some workers have access to institutional funds with expense ratios below 0.10%, while others may pay closer to 0.50% or more once administrative costs are included. Ryan's company plan charges a total annual cost of 0.45%. Ethan builds his Roth IRA and brokerage account using low-cost index funds, charging just 0.03% annually. The difference? Only 42 basis points. Less than half of 1%. Most people ignore it. Over 1 year, it barely matters. Over 20 or 30 years, that tiny percentage quietly compounds against Ryan every single day. It's one of those numbers nobody notices because it never shows up as a bill in the mail. It simply reduces growth behind the scenes. And that's exactly how hidden costs work. They're almost invisible while they're happening. But when enough years pass, invisible becomes enormous. And year 5 is where the first crack in the obvious answer finally begins to appear. Year 5 arrives much faster than either Ryan or Ethan expected. By now, retirement has become automatic. Neither of them debates whether to invest anymore. The money leaves their paycheck or bank account before they even notice it. That's the beauty of a system. Once the habit is built, discipline matters less than consistency. Ryan's salary has climbed to just over $95,000, thanks to annual 3% raises. He's still contributing 10% of his income to his traditional 401k, and his employer continues matching 4%. Between his own contributions and the company match, nearly $13,500 goes into his retirement account this year alone. After 5 years of investing and compounding, Ryan's 401k balance reaches roughly $73,000. He opens his account one Friday afternoon. $73,000. For someone who started with nothing, that feels incredible. He screenshots the balance and sends it to a friend. This is why you always take the tax deduction. On paper, that's $73,000. Sounds amazing, until you subtract everything else. That balance is pre-tax. If Ryan retired today, which he obviously won't, every dollar withdrawn would generally be taxed as ordinary income under current IRS rules. The account statement doesn't show that future tax bill. It simply doesn't mention it. Now let's check on Ethan. His Roth IRA has also benefited from 5 years of uninterrupted investing. Every January, He contributes the maximum allowed under IRS contribution limits. Everything beyond that continues flowing into his taxable brokerage account. His Roth IRA has grown to approximately $45,000. His brokerage account has grown to roughly $30,000. Combined, Ethan now controls about $75,000. Suddenly, something interesting has happened. Ryan no longer has the larger portfolio. The lead created by the employer match has quietly disappeared. Not because the employer stopped contributing, not because the Roth IRA earned higher returns, because Ethan had somewhere productive to invest every dollar that didn't fit inside the Roth. Instead of stopping after reaching the contribution limit, he kept investing. That's the first flip point, and it's one almost nobody talks about. The account itself didn't create wealth. The habit did. Now fast forward another 5 years. Year 10. Ryan is now 40 years old. His salary has crossed roughly $110,000. His annual contributions have increased automatically because they're rebased on a percentage of income. His employer match continues exactly as promised. 10 years of disciplined investing have pushed his 401k balance to approximately $205,000. Crossing $200,000 feels different. The account finally looks substantial. Friends begin asking him for investing advice. After all, the balance speaks for itself. But here's where most retirement conversations become dangerously incomplete. People compare account balances. They rarely compare purchasing power. They almost never compare after-tax wealth. And they almost never compare flexibility. Those three numbers are completely different. Ryan's money is growing tax-deferred. That's a major advantage. But it's also locked behind retirement rules. Generally speaking, withdrawing traditional 401k money before age 59 and a half may trigger ordinary income taxes plus an additional 10% early withdrawal penalty, unless an IRS exception applies. That matters, because life doesn't always follow your retirement timeline. Now look at Ethan. His Roth IRA balance has climbed to approximately $95,000. His brokerage account has grown to roughly $125,000. Combined investments now total around $220,000. Not dramatically ahead, but ahead. More importantly, they're divided into different tax buckets. Some money can potentially be accessed with greater flexibility. Some grows tax-free. Some receives favorable long-term capital gains treatment if sold after meeting holding requirements. Diversification isn't only about investments. It's also about taxes. That's something wealthy households have understood for decades. Different accounts create different options, and options have value. Now let's talk about something almost nobody includes in these comparisons. Employer dependence. Ryan's 401k exists because his employer sponsors it. Most companies offer excellent plans. Some don't. One employer may provide index funds costing 0.03%. Another may offer actively managed funds, charging 0.70% or more. One company matches 6%. Another matches nothing. One plan offers dozens of investment choices. Another offers only a handful. Ryan got lucky. His employer has a solid retirement plan. But not everyone does. According to the Investment Company Institute and retirement industry data, employer plan costs vary significantly depending on plan size and investment options. That difference sounds tiny. It isn't. Imagine two workers each investing $10,000 annually for 30 years while earning the same market return. If one pays around 0.05% in annual fees and the other pays 0.75%, the higher fee investor could easily end retirement with tens of thousands of dollars less. Not because they invested less, not because they chose worse stocks, simply because invisible costs quietly compounded against them every year. On paper, it's less than 1%. Sounds harmless, until compound interest starts working against you instead of for you. That's the second flip point. Now let's zoom out even further. Year 20. Ryan is 50 years old. 2 decades of consistency have transformed his financial life. His traditional 401k balance has grown to approximately $720,000, nearly $750,000. When people see balances like that, they usually stop asking questions. They assume the winner is obvious. But retirement accounts are like wrapped presents. The label doesn't tell you what's inside. Ryan still hasn't paid income taxes on any of that money. Every future withdrawal generally increases taxable income. How much tax he eventually pays depends on future tax rates, his retirement income, and how much he withdraws each year. Nobody knows those numbers today. That's uncertainty. Now let's check Ethan. His Roth IRA has crossed approximately $260,000. His brokerage account has grown to roughly $540,000, despite occasional taxes on dividends and realized capital gains along the way. Combined portfolio value, about $800,000. For the first time, the gap isn't small anymore. It's around $80,000. And remember, both invested approximately the same amount of money each year. Both earned essentially the same market return. Both lived in the same city. Both received the same raises. The difference wasn't intelligence. The difference was structure. But here's the mistake many viewers are about to make. You might be thinking, so Roth IRA wins. Not so fast. Because if that's the conclusion you reached, you've just fallen into the exact same trap Ryan and Ethan did. You looked at one number. Retirement planning has layers. And the biggest layer is the one almost every financial conversation skips completely. What nobody talks about is the flashy number everyone loves to brag about, their account balance. It's the screenshot people post. It's the milestone people celebrate. 100,000, 500,000, 1 million, but your account balance is only the headline. The real story lives underneath it. Let's peel back those layers. First, current tax savings. Ryan reduced his taxable income every single year through traditional 401k contributions. Depending on his tax bracket, that may have saved him roughly 22% on every dollar contributed during his working years. For someone contributing around $10,000 annually, that's approximately $2,200 in federal tax savings each year before considering state taxes. That's real money. Ignoring it would be dishonest. Second, employer matching. Ryan received thousands of dollars he never earned through labor. Over 20 years, employer contributions alone added well over $90,000, and that's before investment growth. No Roth IRA can match free money from an employer. Walking away from a generous employer match is usually like refusing part of your salary. Third, investment expenses. Even low fees compound. A difference between 0.45% and 0.03% may not sound dramatic today. After decades of compounding on hundreds of thousands of dollars, it can quietly cost tens of thousands in lost wealth. Fourth, dividend and capital gains taxes. Ethan's brokerage account isn't completely tax-free. Qualified dividends are generally taxable in the year they this wealth, unless held in certain tax-advantaged accounts. Selling appreciated investments may also trigger capital gains taxes. Those annual tax drags slightly reduce long-term compounding, compared with fully tax-sheltered accounts. Small each year, meaningful across decades. Fifth, future tax uncertainty. Ryan doesn't know exactly what tax bracket he'll retire into. Ethan doesn't know whether future tax laws affecting Roth accounts could ever change. Both are making educated assumptions about the future. Neither has certainty. And that's exactly why the smartest investors don't just chase the biggest balance. They build flexibility, because sometimes the account that gives you the most choices becomes more valuable than the account that simply shows the biggest number. If I only showed you the downsides of the traditional 401k, I'd be doing exactly what too many financial influencers do. They pick a winner before they run the numbers. That's not what we're doing here, because the truth is, there are plenty of situations where the traditional 401k is actually the better choice. Suppose you're earning $180,000 a year, and you're in one of the higher federal tax brackets. Every dollar you contribute to a traditional 401k could save you 24% or more in federal income taxes today, depending on your filing status and current tax law. If you expect to retire with a much lower taxable income, delaying those taxes can leave you with significantly more money to invest for decades. That's real. Now imagine your employer offers a 100% match on the first 6% of your salary. On a $100,000 income, that's another $6,000 invested every single year before you even earn a dollar of market returns. According to the IRS, employer matching contributions do not count toward an employee's annual elective deferral limit, making them one of the most valuable retirement benefits available. Walking away from that match isn't choosing a Roth IRA. It's choosing to reject part of your compensation package. That's a very expensive decision. Now let's be equally fair to the Roth IRA. It has downsides too. The annual contribution limit is much lower than a 401k. If you want to invest $20,000 or $25,000 every year, the Roth IRA alone simply can't hold that much. There are also income limits that may prevent higher earners from contributing directly. although some investors legally use strategies like the backdoor Roth IRA to work around those restrictions under current IRS rules. Then there's the emotional challenge. Because Roth contributions are made after taxes, your paycheck feels smaller today. That makes it psychologically harder for many people to stay consistent. Behavior matters. The mathematically perfect strategy doesn't help if you abandon it after 6 months. Market volatility is another reality. Neither Ryan nor Ethan escaped it. During 20 years of investing, both experienced bear markets. Some years their portfolios dropped 20%. Other years they gained more than 25%. The average long-term return only exists because investors are willing to live through uncomfortable years in between. The account doesn't eliminate risk. It simply changes the tax treatment. So when does the traditional 401k clearly win? First, if your employer offers a generous match, always capture the full match before ignoring the plan. That's free money. Second, if your zero's currently in a high tax bracket, but reasonably expect a much lower one during retirement, the tax deduction today may easily outweigh paying taxes later. Third, if your annual savings goal is much larger than IRA contribution limits, a 401k lets you shelter substantially more money each year from current taxes. Now, when does the Roth IRA have a clear advantage? If you're early in your career and earning relatively little, paying taxes while you're in a lower bracket may be far less painful than paying them decades later after your income has grown dramatically. If you believe tax rates are likely to be higher during your retirement years, tax-free withdrawals become considerably more valuable. And if you want flexibility, Roth contributions, not earnings, but the original contributions, can generally be withdrawn without additional tax or penalty under IRS rules, assuming the account meets the applicable requirements. That flexibility gives many investors peace of mind. But here's the interesting part. The smartest investors rarely choose one account forever. They use both. Think about it. Ryan believed tax deductions were everything. Ethan believed tax-free withdrawals were everything. Both were looking at only one side of the equation. The investors quietly building the most resilient retirement plans often split the difference. They contribute enough to their 401k to receive the full employer match. Then they fully fund a Roth IRA if they're eligible. If they still have money left to invest, they return to the 401k or invest through a taxable brokerage account depending on their goals. Now they're building 3 different tax buckets: tax-deferred, tax-free, taxable. That creates options, and options become incredibly valuable during retirement because they let you decide where your income comes from each year. That's something a single retirement account can never provide by itself. Now let's return to Ryan and Ethan. 20 years later, Ryan's traditional 401k is worth roughly $720,000. Ethan's combined Roth IRA and brokerage portfolio is approximately $800,000. At first glance, Ethan appears to have won by about $80,000. But let's introduce one tiny change. What if Ryan had invested the federal tax savings he received every single year instead of spending them? Remember, every contribution to his traditional 401k reduced his taxable income. If those annual tax savings averaged roughly $2,500, and Ryan consistently invested that money into the same low-cost index fund earning an average annual return of 10%, over 20 years that side account alone could grow to roughly $160,000 to $180,000, depending on contribution timing and market performance. Suddenly the math changes again. Ryan's effective investment portfolio isn't just $720,000 anymore. It's closer to $880,000, or even $900,000, before accounting for future taxes. One small behavioral decision completely changed the outcome. Now flip the scenario again. What if Ethan increased his monthly investing by just $200 because he received a raise and decided not to inflate his lifestyle? That's an additional $2,400 every year, invested over 20 years at an average annual return of around 10%. Those extra contributions could grow to roughly $150,000 to $170,000. Now Ethan moves comfortably ahead again. Do you see what's happening? The retirement account didn't create the biggest difference. The behavior did. That's the lever almost everyone ignores. The account determines how money is taxed. Your habits determine how much money exists to tax in the first place. So if you were looking for a simple answer, which makes more money? The honest answer is, it depends on which math you're actually running. If you compare only today's tax deduction, the traditional 401k looks fantastic. If you compare only tax-free withdrawals decades from now, the Roth IRA looks unbeatable. If you compare only employer matching, the 401k usually wins immediately. If you compare flexibility, the Roth IRA often has the advantage. But once you include employer matching, tax rates today, tax rates tomorrow, investment fees, contribution limits, behavioral habits, and what you do with your tax savings, the conversation becomes much more interesting and much more useful. Ryan and Ethan both walked away thinking they had made the smart play. Ryan believed the tax deduction guaranteed he'd retire with more money. Ethan believed tax-free withdrawals guaranteed he'd come out ahead. Neither of them had actually run the complete calculation. They focused on the feature. They ignored the system. And that's the lesson hiding inside almost every financial decision you'll ever make. The real trap isn't choosing a 401k. The real trap isn't choosing a Roth IRA. The real trap is making the decision based on headlines, social media clips, or someone else's opinion, instead of running the numbers for your own situation. Because your income is different. Your tax bracket is different. Your employer benefits are different. Your retirement goals are different. And those differences matter far more than any one-size-fits-all answer ever could. If you're wondering what happens when someone combines a traditional 401k, a Roth IRA, a health savings account, and a taxable brokerage account into one coordinated retirement strategy, that's a completely different conversation, and it's one that might surprise you even more. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.